Hey guys, today we're going to talk about something that turns an ordinary trader into a systematic pro. This thing saves your deposits, smooths out drawdowns, and keeps your nerves intact. We're talking about diversification. It's that magic word that beginners usually ignore and then end up staring wide-eyed as the market wipes out their deposits. Guys, what is diversification? Simply put, in plain language, diversification is when you don't bet everything on one horse. Or it's like keeping all your eggs in different baskets. In other words, you don't depend on a single asset or a single trade or a single expert advisor. You spread out the risk so that one mistake doesn't wipe out your entire trading account. It's like having several sources of income. While one is down, another one is up. It pulls everything up. It's simple. Now, let's talk about several different ways to diversify risks in automated trading. The first method is multi-currency diversification within a single portfolio. The idea is to use an expert advisor that operates on several assets at the same time. For example, my expert advisor, Swing Master, trades on 17 currency pairs. And this does an excellent job of diversifying all the trading pairs. Because while there is a drawdown on some assets, there is growth on others. That's why usually at the end of the month, I'm always in profit. In other words, within such a multi-currency portfolio, losses on some assets are offset by profits on others. This is what multi-currency diversification is. It works powerfully, especially when the assets are weakly correlated with each other. Guys, the first example of how diversification works is the example of a multi-currency portfolio, where a large number of assets are used on a single trading account. In this case, 17. My expert advisor, Swing Master, operates here, which you receive as part of my automated trading course. You get it for free for a trial period. So, this trading bot uses 17 different currency pairs, and in just 7 months, it has earned a total profit of 73%. So by the end of the year, this will be more than 100% profit annually. As I said, this is the golden mean between risk and profitability. On average, safe trading will always give you about 100% profit per year. It could be more, it could be less, but on average, it will be around 100%. And in this case, our safety is achieved, among other things, through risk diversification. Not only due to a good trading strategy, but also because here the risks are distributed among 17 currency pairs. And when we take a loss on one currency pair and then a loss on a second one, then on the remaining 15 currency pairs we made a profit, and our deposit growth chart steadily moved upward over time, though not perfectly smoothly, because again, we use a stop loss, which is a risk management tool that automatically cuts losses in these unsightly, abrupt steps. But still, thanks to the multi-currency approach, the deposit continues to grow over time. And if you want to grow your capital safely and securely, then, first and foremost, you should choose multi-currency trading bots, where the risks are distributed and spread out among different currency pairs, which helps to reduce the impact of losses on any single pair. This diversification is key to maintaining steady growth and protecting your investment in the long run. That is, by trading on different currency pairs. The second method is diversification by using several advisors. Of course, you need to install them on different accounts. Why on different accounts? Because even the smartest bot can experience drawdowns during certain market phases. If you use several advisors with different logic, different algorithms, and different time frames, you get different results. While one trading bot is in a drawdown, another bot is in profit. Guys, another example of diversification is when we use different trading bots with different trading strategies on different trading accounts. And thanks to the difference in results, we get excellent, broad diversification. Now I'll show you its advantages. Look, I'll start with an example. Let's say one of our trading bots started making a loss, and over 4 days in November, today is November 4th, it brought us a 1% loss. That's not a lot, and I'm sure it will trade it all back and start growing again. But right now, we have a situation where we have a 1% loss. If this were our only trading bot, the one we use, then right now I would be upset and thinking, well, minus 1%, oh no, that's not good. But I have a lot of trading bots. And by the way, what I've made public is probably only about 1/10 of what I actually use. So let's go to the Swing Master portfolio together and take a look at how, over the 4 days of November, we've made almost 1% profit. Let's move on to the next account. Here, we have a little more than 0.5% profit. So we've already covered that loss and earned even more. But that's not our only trading account, because we have more. Here, in November, they haven't earned anything yet in these 4 days. Here as well, nothing has been earned yet. And here, we have just under 0.5%, so this loss has already been covered. And here, we already have some profit percentage. And here, we have almost 2% in November. Pips Hunter earned that. Although its profit chart isn't very smooth, we don't evaluate it by the smoothness of the profit chart, but by its technical results. Here we have September, October, November, profit everywhere. So it doesn't matter how it worked here or what kind of drawdowns it had. What matters is that it brings us profit every month. So, this is the overall result across all trading bots, and this small loss on one of the trading bots, they are indeed quite comparable. And thanks to the difference in strategies that I employed, I was able to offset and ultimately earn much more than the loss that was incurred on this particular trading account. This is what is known as broad diversification, and if you use several different trading bots, you will truly feel and experience the power and benefits of diversification in your own trading. You'll essentially have your own little hedge fund running right on your computer once you allocate your funds in a thoughtful and strategic manner. You don't actually need a lot of capital for this. In principle, to use 3 or 4 expert advisors, or even 5, you only need, let's say, $3,000 or $4,000 to already create your own diversified portfolio, which is quite accessible for many people. Of course, this is only the case if you use trading bots that don't employ risky or aggressive money management methods, which can otherwise increase your exposure to potential losses. By carefully selecting your bots and diversifying your strategies, you can build a robust and resilient portfolio that is better equipped to handle market fluctuations and unexpected events. All my bots operate safely, so you can use mine or any others. But the main condition is that there is no martingale, no averaging, and none of those other bad practices that can wipe out your deposit. So that you know for sure your deposit won't disappear all at once, because if we had a minus 100% here, of course, we wouldn't be able to recover it in a month. But in this particular case, even if we end up with a 5% loss in a single month here, and this chart for a single trading bot drops all the way down to 0, thanks to the overall profitability of all these portfolios, we still get an overall positive result in the end. The growth chart of our capital at the end of the month. This is excellent, guys, because in this way you can earn profits for years, even decades, building your own small investment fund right on your computer. And you won't be dependent on any bank or other investment companies, any investment platforms, or any cryptocurrencies. Why? You have your own awesome, cool portfolio that will give you more than 100% profit per year with minimal risks, without a crypto winter which can drag on for a year or a year and a half. Every month you'll have the total profit from your capital. That's how cool this works, friends. Overall, you get more stable growth and lower risks. Let me give you a real-life example. Imagine you have 3 expert advisors. One expert advisor is a scalper that catches short impulses on the EM15 time frame. In other words, it's an intraday trading bot. The second is a medium-term bot that trades on reversals on the H1 time frame. The third is a trend-following bot that holds positions for days. If the market goes sideways, the scalper makes money while the trend bot takes a break. The medium-term bot might bring a small profit or a small loss. It all depends on the market, but overall we end up with a profit because the scalper earned well during this period. If a strong trend starts, then the scalper takes a break and the trend following bot brings in significant profit. Again, we're in the black. So, as a result, regardless of market phase changes, you always have one of the trading bots actively generating profit, while the others may be idle or experiencing a small drawdown. Overall, this is always or almost always profitable. So guys, why is diversification the key to survival? Because it's not just smart advice. It's the foundation of professional automated trading. Without diversification, you're dependent on a single algorithm or a single asset or a single market mood. But with diversification, you become like a hedge fund. Stable, flexible, and earning more than most traders on the market. And of course, with significantly less drawdown in your trading. And I'm not saying goodbye,